For the first time since 1967, a founding member of OPEC has walked out. The United Arab Emirates, the cartel's third-largest producer, announced it is leaving the group after 6 decades of membership. Oil climbed above $110 a barrel, and on the same afternoon, the yield on the UK 10-year gilt crossed 5% for only the third time since the Iran war began. That is not a coincidence. It is a pressure chain. The FTSE 100 edged higher, lifted by BP, which reported that underlying profit more than doubled in the first quarter, from $1.5 billion to $3.2 billion, smashing analyst forecasts of $2.7 billion. BP described the quarter as exceptional for oil trading. British Airways owner warned it will raise airfares as fuel costs soar. Taylor Wimpey flagged that war-driven cost pressures are squeezing margins on new homes, and retailers, according to the British Retail Consortium, are applying heavy discounting to shift goods as consumer confidence crumbles. 2 stories dominated the day. One was the UAE's departure as a political rupture as much as an economic one, reopening a long-simmering conflict between Abu Dhabi and Riyadh over production quotas. The other was the rent freeze that was and then wasn't. Rachel Leaves was reported to be considering a 1-year private rent freeze. Buy-to-let lender shares fell sharply, and then Downing Street denied it within hours, calling the policy not the approach we will be taking. By close, the housing sector was nursing losses, and the Chancellor had not clarified her position. Underneath both headlines, one number was flashing a warning that neither story fully addressed. UK government borrowing costs have risen more than any other developed economy over the past 2 months. That sentence requires a second read. Not more than some, more than any. The 10-year gilt yield hit 5.1% on Tuesday and held there. The 2-year gilt has risen by more than a full percentage point since the Iran war broke out. Lucy Smith at Killick & Co. framed it plainly. This is bad news for Reeves as she attempts to contain government borrowing costs while inflation expectations jump. Now the UAE factor arrives. The Emirates was not just any OPEC member. It had the most vocal case for higher production quotas, had clashed repeatedly with Saudi Arabia over output ceilings, and had been looking for an exit for years. Its departure weakens the cartel's ability to coordinate supply cuts, meaning oil markets now have 1 fewer break on production, but also 1 fewer stabilizer if prices spike further. Here is the mechanism the gilt market is pricing. Higher oil means higher inflation. Higher inflation in the UK means the Bank of England cannot cut as fast as the market hoped. The BOE already voted 7-2 to hold last week, with 2 dissenters pushing for a hike. If oil stays above $110, the 7-2 hold could flip. And if it flips, the mortgage market, which only last week was celebrating its biggest rate fall in over a year, reverses again. BP's profit doubling is not the story here. It is the symptom. The question is what a permanently fractured OPEC does to the supply side, and whether the UAE's exit is the beginning of a broader cartel unraveling or a one-off driven by bilateral Saudi tensions. There is a condition buried in that question. The UAE exiting OPEC does not automatically mean it pumps more oil. It means it is no longer bound by OPEC quota agreements. Whether Abu Dhabi actually increases output depends on its own infrastructure timeline and its interest in keeping oil prices high for its own fiscal revenues. An unconstrained UAE that chooses restraint is very different from one that floods the market.
The current evidence leans towards sustained pressure on UK gilts. 3 forces are reinforcing each other. The Iran war keeping oil above 100, the UAE's exit removing 1 layer of OPEC coordination, and domestic UK politics adding a 4th uncertainty, a chancellor who floated a rent freeze and then retreated within the same news cycle. That political noise matters for gilts. The UK's borrowing costs are sensitive not just to inflation expectations, but to confidence and fiscal discipline. When the government signals to intervene in private markets under crisis pressure, bond investors price in less predictability. The gilt move this week is not purely an oil story. The scenario where this pressure eases, ceasefire talks between the US and Iran showed genuine progress, oil falls back toward $90, as it briefly did when the Strait of Hormuz reopened in an earlier episode, and the BOE's next meeting sees the dissenter count stay at 2 rather than grow. Under that sequence, gilt yields could pull back below 4.8%.